To speak of the Silk Road is not to describe a single road, nor even a single system of trade, but to enter a vast breathing network of exchange that stretched across continents and centuries, binding together empires that never met cultures, that never spoke the same language, and economies that depended on one another without ever fully understanding how deep that dependence ran. Long before globalization became a modern anxiety or a buzzword of finance, the Silk Road was already teaching humanity its first brutal and beautiful lesson in interconnectedness, that wealth could be created far from home, that prices were shaped by distant events, and that power increasingly belonged to those who could control flows rather than territories. From the perspective of financial history, the Silk Road was not merely about silk spices or luxury goods, but about the gradual transformation of value itself from something local and concrete into something mobile, abstract, and globally conditioned. In its earliest form, the Silk Road emerged not from grand strategy, but from overlapping survival needs. Chinese dynasties sought horses and military security on their western borders. Central Asian nomads sought grain and manufactured goods. Indian merchants carried spices and textiles, and Mediterranean powers hungered for luxury items that signaled status and refinement. These exchanges did not occur through free-flowing markets, but through layered systems of tribute, gift exchange, regulated trade, and state-sanctioned monopolies. Silk, the most famous of these commodities, was valuable not because of its utility, but because it embodied concentrated labor secrecy of production and imperial prestige, making it an ideal store of value and diplomatic currency. In a world where portable wealth mattered more than bulk commodities. What made the Silk Road economically revolutionary was not volume, but reach. Most goods moved only part of the way, changing hands dozens of times across caravan cities like Samarkand, Bukhara, and Palmyra, where merchants, money changers, and state agents translated not only languages, but systems of value. A bolt of silk leaving Han China might be priced in bronze coins, revalued in silver weight in Central Asia, converted into Roman gold in the Mediterranean, and finally displayed as clothing that signaled elite power rather than market price. This constant repricing forced societies to grapple with exchange rates, arbitrage, and monetary trust, long before modern finance gave these concepts names, and it quietly trained civilizations to think beyond their own borders when assessing worth. Crucially, the Silk Road functioned as a financial shock absorber between empires. When Rome experienced silver shortages, Eastern goods became more expensive. When Chinese dynasties weakened, silk flows declined, and Central Asian economies suffered. When Persia tightened control over transit routes, prices rippled outward across thousands of miles. These were early versions of balance of payments. Pressures, trade deficits, and supply chain disruptions, felt not through spreadsheets, but through scarcity inflation and political tension. Roman writers complained that gold flowed east in exchange for luxuries, echoing anxieties that feel strikingly modern, because already elites understood that persistent trade imbalances could drain monetary reserves and weaken states, even if consumers delighted in foreign goods. The infrastructure that supported this trade was as important as the goods themselves. Caravanserais provided credit storage and security. Merchant diasporas built trust networks that reduced transaction costs, and states extracted revenue through tariffs and protection in exchange for relative safety. This was not laissez-faire commerce, but negotiated globalization, where profit depended on navigating political authority as much as market demand. Merchants thrived not by defying empires, but by understanding them, aligning with their incentives, and exploiting the gaps between jurisdictions, an economic skill set that would later define global finance itself. Yet the Silk Road's greatest impact was invisible, because along with silk and silver traveled ideas about money contracts, accounting, and risk. Paper money concepts moved westward from China. Credit instruments and bills of exchange took shape through Islamic and Central Asian intermediaries. Insurance-like arrangements emerged to spread the dangers of long-distance trade. These financial innovations did not replace older systems overnight, but layered themselves atop them, increasing the speed and scale at which value could move. The more abstract trade became, the more it relied on trust rather than force, and the more devastating the consequences when that trust broke due to war plague or political collapse. Over time, the Silk Road revealed its own fragility. It flourished when empires were strong enough to protect roots, but restrained enough not to strangle them, and it declined when fragmentation, insecurity, or over-extraction made long-distance trade too risky or expensive. The fall of the Han dynasty, the fragmentation of Rome, and later the disruptions caused by pandemics like the Black Death all showed that global trade networks amplify both prosperity and vulnerability. When the system worked, wealth accumulated. When it failed, regions that had grown dependent on distant markets found themselves exposed, a lesson that echoes painfully in every era of globalization that followed. Seen through a financial lens, the Silk Road was humanity's first rehearsal for a global economy, teaching societies how prices transmit information across distance, how money adapts to cross-cultural exchange, and how power shifts from those who own land to those who control circulation. It was not a golden age of harmony, but a complex, tension-filled system that rewarded flexibility and punished rigidity. And as we move forward in this story, we must now examine how the decline of overland trade and the rise of maritime routes did not end globalization, but transformed its financial logic, entirely shifting the center of gravity from caravan cities to port cities, from land empires to naval powers, and from tribute-based systems to capital-driven expansion in ways that would redefine risk wealth and empire itself. And it is precisely at this turning point, when the ancient world's first global trade network began to fade, that the deeper consequences of the Silk Road become visible, because its legacy did not vanish with the caravans, but re-emerged in new forms that would shape the modern financial world in ways few of its participants could ever have imagined, as they loaded camels under desert skies and trusted that distant markets would still exist when their goods finally arrived. And the story must now continue into that transformation where continuity hides beneath apparent rupture, and where the logic of global trade survives even as its routes, rulers, and instruments change and adapt to a world on the edge of a new economic era, driven by oceans rather than sands, and by financial abstractions that would carry the Silk Road's DNA forward into the next chapter of history. As we now turn toward that unfolding shift and follow the thread of value as it begins to slip from the hands of caravan merchants into those of maritime financiers who will reshape the world in ways both familiar and unsettling, continue into that transformation. Because the decline of the Silk Road did not mark the end of global trade, but the migration of its logic from land to sea, from caravans guarded by empires to ships financed by capital. And this shift would permanently alter how risk money and power interacted. As overland routes became more vulnerable to political fragmentation, warfare and plague, maritime trade offered scale and speed, but at the cost of immense upfront investment, pushing economic power away from individual merchants and toward pooled capital joint ventures and early financial markets. In this sense, the ocean did not replace the Silk Road. It absorbed it, carrying forward its core insight that those who control circulation rather than production alone shape the world's wealth. The rise of maritime empires in the Indian Ocean and later the Atlantic reproduced Silk Road dynamics in financial form. Arab, Indian, and Chinese merchants had already developed sophisticated credit networks, partnership contracts, and risk-sharing arrangements to manage long voyages, and European powers learned quickly that naval dominance meant little without financial architecture. The Portuguese, Dutch, and British did not outcompete over land trade because they were braver or more virtuous, but because they learned how to price risk, securitize uncertainties, and mobilize capital at a scale caravans never could. Joint stock companies transformed trade from personal adventure into institutionalized speculation, allowing losses to be absorbed and gains to be amplified. And this innovation echoed the Silk Road's earlier trust networks, now formalized through contracts, shares, and state backing. Yet the financial DNA of the Silk Road remained visible in the fragility of these systems. Just as caravan cities rose and fell with political stability, port cities boomed and collapsed with wars, defaults, and shifts in trade routes. Venice, Antwerp, Amsterdam, and London each inherited the mantle of global exchange, in turn not because history favored them, but because their financial institutions aligned most effectively with the demands of long-distance trade at that moment. Capital flowed toward reliability, transparency, and enforcement, the same qualities that once drew merchants to Samarkand or Kashgar, reminding us that geography matters less than trust when value must travel far from home. The Silk Road's most enduring contribution, however, was psychological. It taught civilizations to think in terms of distant demand, delayed settlement, and abstract profit conditioning societies, to accept that wealth could be created invisibly far from fields and workshops. This mental shift prepared the ground for modern finance, where value often exists only as expectation priced into futures, bonds, and currencies. The caravan merchant waiting months for news of prices in a distant market was already practicing a form of temporal arbitrage, living in uncertainty that would later define investors and speculators across the world. At the same time, the Silk Road exposed the moral tensions of globalization. Luxury consumption in Rome drained bullion eastward. Dependency on foreign markets destabilized local economies, and inequality widened between those connected to trade networks and those left behind. These patterns resurfaced in maritime empires and continue today because global trade amplifies rewards for intermediaries and financiers while concentrating risk among producers and laborers. The ancient complaints of Roman senators about silk imports and moral decay sound uncannily like modern debates about trade deficits and cultural erosion, underscoring how deeply the Silk Road imprinted itself on economic consciousness. In the end, the Silk Road did not fail because it was inefficient, but because it reached the limits of the political and epidemiological systems that sustained it. When protection vanished and trust collapsed, the network fragmented, but the idea of a connected world survived, re-emerging wherever conditions allowed flows of goods, money, and belief to move safely across distance. This continuity is the central lesson of the Silk Road's financial history, that globalization is not a linear ascent, but a recurring pattern, expanding and contracting as societies renegotiate the balance between openness and control. If we step back far enough, the Silk Road appears less as an ancient curiosity and more as a prototype, a first draft of a world economy that we continue to revise. Its merchants, money changers, and risk takers were not relics of a distant past, but early participants in a system we still inhabit, one where prices transmit information faster than armies, where trust can be more valuable than territory, and where financial imagination often outruns political capacity. Understanding this lineage does not make modern globalization safer, but it makes it legible, and in that clarity lies the only real defense against repeating the most costly mistakes.